Hey, what's up, guys? Today I want to talk about opening balance equity and how you can set that up when you have a brand new business. So we're going to pretend that I had a business in 2013 and now it's the beginning of 2014 and I'm just setting up my QuickBooks. So I want to try to get as much information as I can into the books without having to go back and do every single transaction in 2013. So we already filed our taxes in 2013 and we just kept track maybe through spreadsheets, whatever. And now so we have our QuickBooks that we just started in 2014 and we want to bring that all in. So this is where you utilize opening balance equity, and I'll show you why. So we're just going to start in the balance sheet and we'll just simplify it enough where we're just kind of going down the line. So we want to bring in our bank accounts, and that's where we'll start. We'll bring in any kind of fixed assets that we have, any credit cards that we may have, and then everything else will go into this opening balance equity to balance out the assets and liabilities. So I'll make an example here of just my bank account. So we can just say we'll just label it opening balance 2014, and then our date will be the last day of the previous year. So we'll do 12/31/2013, and then you'll come into your bank statement. So we're gonna say I just had one bank statement or one bank account for my business. You want to go the end of the year, so 12/31, you'll have your ending balance, so it's $991.49. So that's what we're going to put in here. Whatever your bank account is, so we'll have this bank account, and then because it's an asset, when assets go up, we debit it, and it's the $991.49. Okay, and then if this was like the start of it, we will offset it, we'll credit it with this opening balance equity. I'm just going to save and close this, and then we'll see on our balance sheet we now have our bank account. This should be the total that we have in the account on the 1st of 2014. Then when we come down here, we see our opening balance equity at $991.49. Okay, so let's kind of go down the line here and just start adding some more things to it. So we're gonna say that we have a couple properties. So your previous tax return should have an 8825. It'll look something like this. And let's just start adding this in. So we'll get rid of this opening balance for a minute. And we'll just start making some numbers up. So whatever it may be, you need to find that out with your client, or if you're doing your own books, maybe get with your CPA and just try to figure out what kind of numbers you had for your different properties. So you determine what your land is, what you think your value of your buildings, closing costs. So you could even go back into your HUD statement and get all this information. And then we'll just pretend that we actually put money into our real estate as improvements. So we have a CapEx account or a capital improvement account. And then we'll just kind of put these in as we go. So we're going to debit all of these. So we'll say that this property is worth $300,000, and we decided that 15% of it goes towards land. All right. So there's the value of the building. We'll say that 3% went to closing costs, and maybe you put 10,000 into it in 2013. All right, and then we'll just put a class in here. So we'll say this was 101 Main Street. And let's go ahead and put in our other property. Well, actually, let's go ahead and maybe we'll just keep this together. So we have our 101 Main Street. So we'll say this was property A. If you want to put in this information, you can. If you have it, it doesn't hurt to just have more information if you wanted to add all of this. So this would be on your P&L. So we could put in our rental income. Okay, and we're going to credit that. So that's $31,345. We'll put the class in. Okay, and then we have our legal and professional fees. And these are expenses. We're going to debit this for $1,500. We had the interest for $11,796. Taxes. So we have our property tax at $39.40. Our utilities. And we had that for $22.16. And then we have our depreciation. So if you haven't set up a depreciation, you would have one that would be like an accumulated depreciation. That would be an asset. So on this form, we're decreasing the depreciation. So because it's an asset, we're going to credit that, so it'd be $51.58. And then you would have a depreciation expense account, which you would debit for the same amount. So that'd be $51.58. Put in the class. All right, so we do have another property, but I'm going to go ahead and just save this so we can save our work. So we'll put opening balance equity, and we'll save this. And let's go into our balance sheet here. And now we can see we have our balance in our bank account, and then we have our property sitting right here. So now we have our value for our property plus the depreciation. we'll see our opening balance, and then we also have this retained earnings because we are putting in everything from 2013. So if we come in here to the previous year, you'll see that the retained earnings is in the net income. So we'll just quickly go into this profit and loss just to see it. So now we can show what the rental income was, what our expenses were for 2013, and we have our depreciation expense. Okay, so let's go back into our current year. Okay, so there's nothing in the profit and loss. And we'll stick to the balance sheet here. Alright, so let's do our second piece of property. So we're going to get rid of this opening balance for now. And let's do the same exact thing. So we have the land, building, closing costs, and capital improvements. Okay, so we'll say this one was worth $450,000. We'll do 15% towards the land. Okay, there's our value of the building. And then we'll say 3% again went to closing costs. And we'll say 25,000 we put in to improvements. All right, and then we'll put in our class here. Okay, and then we'll bring in this information as well for our second property. So we had rental income. We'll credit this for $58,920. Okay, legal and professional fees, we will debit this for $1,560. We have our interest expense, $47,480. For property taxes, $45.26. Utilities, $34.56. And then our depreciation, and you can even, if you wanted to, put the depreciation in a separate journal entry to keep it separate, but we'll just do it in the same journal entry for now. So we're going to go ahead and credit this for the accumulated depreciation, $18,890, And if you haven't seen my video on the depreciation, go ahead and check that out and you'll understand the chart of accounts that I set up for that. And then we'll do the depreciation expense for the same amount. Okay. And again, we'll end it with the opening balance equity so we can get the assets and liabilities equaled out. Okay, and then let's put in our classes. Okay, we'll save that. And let's refresh this balance sheet. So it's all going to look the same here. We have our adjustments now for both properties, our opening balance equity, and then our retained earnings. Okay, so I'll quickly show you what it looks like with the classes. Okay, so now we have both properties, and you'll see everything that we put in here is now up to date. And we'll have our retained earnings for both from the previous year. Okay, so the last thing that we'll do is we'll make one more journal entry to take this opening balance and move it all into retained earnings. So we have the 794, 749. So let's do a new journal entry. And we're going to do the first of 2014, and we'll say opening balance to retained earnings. So we'll do our opening balance equity. And since we're going to bring it down, we're going to debit this to 794, 749 cents, and we'll credit the retained earnings. Okay, and we'll refresh this. Now you'll see the opening balance is 0. We have our retained earnings from the previous year. And now that if you bring in all the information, you would do the same thing. If you had credit cards, you would put that in there. If you had any kind of loans, you would want to make sure that was on the journal entry. And then once you have everything in here, that's when you would move that opening balance equity to that retained earnings. And then you should be set for 2014 or whatever year you're working in. So you shouldn't have to mess with opening balance equity once you do the previous year. You'll zero that out, and then from this year forward, it should be just coming from your bank transactions. So anyways, I hope that was helpful. I hope that makes sense. And that's really what this is for. And it's just to help you put in a certain number so that you can have a correct balance sheet at the beginning of the year that you're trying to get your books cleaned up. And It's just a way to balance out the assets and the liabilities and equity. So this is just numbers that you not sure where, if maybe you'd put in that amount of money into your company last year. Maybe you took a certain amount out, but this is going to tell that story of what was missing from the information that you couldn't find. So it's not perfect, but that's a way to get around it without having to go back into that previous year and literally do every single transaction. You already have your taxes filed, so there's really no need to have to go through all that unless you really want your books to be completely accurate. But this is the workaround. If you just wanted to start fresh from that year, you would just use this and then transfer it over to retained earnings on the first, and now you're ready to go for this year. So I appreciate you guys watching. If you have questions, of course, leave a comment below, and I'll see you on the next video.